Okay, folks, welcome back. It's presently Monday, October 10th, 2016. Today's discussion is going to be about perspective and growth, and the theme of our second month of the mentorship is dealing with risk. And part of dealing with risk is weighing out and keeping in balance our expectations, our aspirations, our hopes, our goals. And some of you in our mentorship are 100% blocked, okay, or your life or your work or your business, time of day, your location around the planet, all those things are factors with you and your trading. And sometimes that's going to prevent you from doing certain types of trading, i.e. day trading, scalping, um, short-term trading. Some of you are just going to have to require long-term trading. Some of you can't do long-term trading. Okay, so I want you to remove those barriers just for a moment while we're looking at this discussion, okay? And I want to show a couple different examples and kind of like bring back the focus to the element of understanding price is important because it's not limited to any one discipline. In other words, it's not only uniquely um, efficient in one time frame or over another. And I'm going to hopefully communicate that in this presentation. Okay, obviously we have a chart here. It's a candlestick chart, as some of you are used to seeing. And for the purpose of just study of price only, I've removed any identification as to what it is. You don't know if it's a stock. You don't know if it's a commodity. You don't know if it's a currency. You don't know if it's Bitcoin. You don't know anything. Okay, and I'm trying to teach you today that it's not necessary to know what that is. Okay, we don't know if this is a 1-minute chart. We don't know if this is a 2-hour chart. We don't know if it's a daily chart. We don't know what this is. Okay, but I want you to focus just primarily on the things I'm going to highlight here. Now, this is going to be very beneficial for those that have gone through all of my free tutorials and have an understanding of some of the concepts that I'm going to refer to in brief terms, highlighting specific things. If a term or a concept is utilized in this presentation, which won't be a long one, if something comes across and you don't know what that is, all you have to do is simply make a notation in your notes in the form of a question. What was whatever it is that you heard me say? And then you wait for the discussion to end today, and then also wait till we finish the presentation for this particular month, because everything that I'm talking about, you'll have more information given to you as we go through. Okay, I'm not trying to leave you with an incomplete study for the month. I'm going to give you a broad brush idea throughout the entire month, but I'm going to sum it up so that way you can walk away from it. Even if you wanted to quit the mentorship, the content for just this month will be enough in terms of standing alone on the basis of what I'm trying to specifically teach regarding risk. But when we refer to risk, obviously it's not just simply limiting how much you're willing to risk and lose on your losing trades. It's also the balancing of your expectations. And if you go back through your losses, I guarantee you they were mostly attached to the fact that you were trying to make a lot of money on that one trade. And either you held onto the trade too long and you married it and you wouldn't accept the fact that you're potentially wrong and you didn't cut bait when you should have. You held on to it when you should have let go of it. Or you demanded too much from the move. That's all part of the balancing act as a trader. If you understand price, if you understand the things that I'm going to teach you and have been teaching for years, and now because of the mentorship, you're in great detail of the studies, I want you to focus on some specifics in this specific time frame that I'm using here. And when we come away with the takeaways, if you will, what you should be gleaning from all this, I think you'll be impressed, because there's nothing like this. It's amazing how you can go in any time frame and see this. I gave you a couple things to look for in September in terms of what to focus on right now. And if you look at the market up here, how many times have we talked about a market breaking above a previous high? When it does that, chances are it's probably going to go lower, even if it continues to go higher. It's going to be a retracement of some kind. When price reaches into a significant resistance level, okay, and resistance can come in the form of a bearish order block, which is usually an up candle prior to a down move in price like this. This up candle being bullish right before the downswing in price, this constitutes what we call a bearish order block, because we understand that during the up moves, smart money sells into that. They want to sell into it as it hits the highest point, so that way they can be selling at the nearest highest point at a premium. When price starts to drop away, we look for price to return back into that order block. Price won't always go up into the actual last candle, but we have to look at the way price has been delivered. We have 3 green candles making up that highest high, 3 consecutive up candles. The order block itself, because of this time frame, we don't know what time frame this is. We don't care. Okay, we're only looking at the fact that price has been delivered 1, 2, 3 consecutively up candles. So this entire price move with 3 candles going up, that is the bearish order block. As price breaks down through those consecutive 3 candles, this becomes at the bottom of the lowest of the 3 up candles. That becomes the beginning point at which the algorithm will reach for and then go into a sell program. Price sees that happening here, trades right up into that candle, only stays there for a short period of time, and then quickly reprices lower. When price goes lower, it's reaching for this short-term low, which is what? A liquidity pool. What rests below these short-term lows? Sell stops. Why is it sell stops below this low? Because price has rallied prior to it. So when the market comes down, they sold up here. They want to buy it back where there's going to be willing sellers. Once price goes through that, the next level at which they would be aiming for, below these lows over here. What resides below these lows? Sell stops. Market trades down below that. Those sell stops become market orders. The smart money can buy them from the sellers here back to cover the short position they assumed up here. Every time the market makes a price swing lower and it creates an up candle, we look for price to trade back up into that, and it should be another area at which there should be selling, because up candles, smart money sells into. If the direction is implying that the market's going lower, okay, let me double check real quick, make sure you guys can see my cursor. Can you guys see my cursor as I'm going across this chart? I just want to make sure. Thank you, appreciate it. I hate breaking up the continuity, but I just want to make sure I'm not wasting my time and yours. So we have this up candle here, price trades right up into it. Now notice it's the wick. Now we don't know if this is going to be a 1-minute chart. We don't know if it's going to be a 6-hour chart. It doesn't matter. The fact that the price is being delivered here, we understand that this has been a rally up. So smart money is going to be wanting to sell into this drive up. And it's only going back to a point at which we would reasonably expect new selling to come in. Why? Because this 3 consecutive up candles together blends what? One bearish order block. So when price hits that, they could sell again, or we can be sellers as well and expect price to expand down below the swing over here and below over here. Now we don't know if it ultimately is going to go down to this low here, but we reasonably expect it to trade down below to this low here. That's reasonable. Now the question is going to be, okay, if say this is a 1-minute chart, and if you're selling at the bottom of this lower 3 candles here, if we sell below that, or sell at that low rather, okay, how much distance is from here at this low, selling over here on this candle, to here? Well, if this is only a 1-minute chart, obviously it doesn't frame much in the way of profitability. Even if you can define the risk, even small, however small you want to make it, if it doesn't offer you an opportunity to make money in terms of where you want to get in at and where the ultimate objective is to get short, and then cover that short position, it's a rather moot point to do that. You don't want to focus too much attention on trades that give you very little payout, very little risk. Okay, doesn't justify the trade. It has to have a way of, number one, giving you a small amount of risk or a measurable amount of risk, but also give you enough movement to provide profitability. So when we frame specific risk to reward ratios, okay, they have to be favorable. And just because it allows us a little bit of difference in terms of change between where we want to get out and where the next level is that really a trade that's viable for you? Because just simply because there's a little bit of movement, between where we think it's going to go or come from down to, that may not be enough pips. In other words, say this is from selling at this low here on this candle and then covering down here. Say that's only 12 pips. Is that something that someone would want to take a trade on? Because remember, if you're looking at 12 pips range, you have this spread on both ends of your trade, buying and selling or selling and buying it back. How much room do you have to make in terms of pips there? To me, that wouldn't make any sense. But you'd be surprised how many people actually try to do that because they want to get in the market for whatever reason. They just want to get in there. And it's usually after the market's already moved a little bit and they say, okay, well, I want to get something out of the marketplace. Even if I get 3 pips, 5 pips or whatever, they think that's the way market makers, or not market makers, profitable traders make money. They get in there and scalp a couple pips here, 5, 10 here. And it's ludicrous. It's stupid to do that. Okay. As price comes back up and trades into this candle here, we get one more opportunity to sell off. Okay. And then it aims for these swing lows over here. We get a nice run down here. What is this? These 3 consecutive candles down here. That is the liquidity void, quick, all one-sided movement. Price comes back and retraces, goes right back up into this up candle. What would be expected here? New selling, and then the price expands again, and then comes back up, and now watch what happens here. Price only comes up to the bottom of these 2 candles. This is actually a mitigation block. For orders that would have been bought, and now this is something we're going to talk about in regards to market structure, institutional market structure. Let's be specific here, Michael. The idea that just simply because the market comes up to here and sells off, if you understand the breakers, okay, that was taught in the Market Maker series on my free tutorial page, this is not a breaker. Okay, this is just a mitigation block. The individuals that would have used orders to go long in here, once price breaks down below it here, these orders would be underwater. So they're going to have to take those positions off here, right when it trades back at the bottom of these candles here. And then we see another round of selling. When it sells off, where does it reach for? Right below these lows. And it does that here. Rallies back up. What's it reach up into? The last little up candle right in here. So you can expect to see what? Selling again. Where does it go down to? Below this low right here. Okay. So you can see many times the opportunity to see these specific generic characteristics repeat themselves over and over and over again. Now, if I told you this was a 1-minute chart, obviously, for anyone that's been trading for a long period of time, it's not terribly exciting because you know the ranges are going to be really small. But what if I told you this was a 4-hour chart and every one of these swings offered 50 to 60 pips every single time it retraced? It was giving you 50 to 60 pips. So now suddenly, for those individuals that don't see these opportunities or can't get in there and trade these 5-minute setups or 15-minute setups, they can now walk away from the market today, hopefully thinking, well, I don't need to have a lot of trades. All I have to do is wait for these things to set up on a 4-hour chart, and then I'll just wait, and I can set my limit orders. I know where my objectives are going to be. I can do all those things in advance. Let me ask you this. What about this movement in here? Okay, even if we see this as a turtle soup or a false break below this low, the question always comes up as, well, how do I know it's a turtle soup? How do I know it's not going to go through this low here and just keep on going? Well, the thing is we don't always know that for certain, but we do know that there is always a likelihood for it to happen, and all we have to do is wait for it. It makes the low, it breaches the candle's bodies here, okay, and then it rallies up. Well, at this point, what do you start looking for? You don't have to trade down here on the break below this low. You look at the down candle right here. This is a bullish order block. Price breaks through this candle, the down candle, which is a bullish order block because they buy during down candle moves. This candle breaks it here. So now at that point, you draw this out in time. Anytime it trades down into that candle again, you can buy it. It does it here. So you can be a buyer here. It only goes down to the middle of the down candle, which is the mean threshold. Okay, so now if this is a 4-hour chart and we're buying somewhere down here, okay, and we can look for an objective above this swing high. If we do this, okay, and this is a 4-hour chart, how many pips, if you have understood anything about 4-hour charts, if you studied and looked at them, the pips, that magnitude of pips are pretty significant sometimes, right? Now, if you were just buying down here, the middle of this down candle here, buying that on a limit, using a 4-hour chart, using this as an objective to exit on a limit, okay, you would have your entire trade framed out with a time frame that you don't have to be sitting in front of and babysitting. That's the beauty of this. And here's the other thing. If you can take first profit here, okay, where would your next level of objective be? You have this up candle right before this down move, which is a liquidity void. And then look at these equal highs up here. There's a liquidity pool resting above that. Liquidity void, liquidity pool. Price goes through both of them. It pierces this one here just by a little bit. And then what's it do? Trades back down. What's it go down to? Right into this bearish order block. I'm sorry, bearish candle, which is a bullish order block. Now, on this time frame, we could go down to a lower time frame and find something smaller. It would probably reside inside of this wick in here. But because if we're assuming this is a 4-hour chart and you're only looking for setups based on these ideas, if you went long here, you would be expecting to take profit where? Above this old high. Price does that here. Okay? Now, here's the cool part. Here's the really cool part. What if this was a daily chart? What if every one of these candles represented a daily range? How many pips would there be there? Hundreds, right? It would be hundreds of pips. What if this was a weekly chart? How about it was a monthly chart? Nothing's changed. It's all the same concepts. Look at this here. If we were looking at this segment of price action, what would you reasonably expect to see happen? I'm actually going to look for feedback on this one. I'm getting a mix here of 50-50. Some are saying going higher, some are going lower. What would you reasonably expect to see price do looking at the price as it is right now? Do you see this segment of price action in here? And then what happens here? What's going on here? All this here, it's expansion. What's this little area in price right in here? Fair value. So price is reaching back down into fair value. And what's this black candle here? It's a bullish order block. The market has shown a willingness to break through this level here by trading higher. It came back down into an area of fair value, which is this big candle up, breaking through this bearish candle here, which is a bullish order block because they buy when it's going down. If price were to trade back down into this candle here, we could reasonably expect to see what happens. Or what would you want to do? If price did this, trading right into that order block right there, what would you expect to see price reasonably do? And where would you ultimately look for it to go? Well, we could be a buyer down here and look for price to trade up to this high here, right? That's the reaction of it hitting it with a bold-faced candle. Then it becomes a wick. You have to get used to seeing it when it's trading right down, as when it's trading at the candle. I'm sorry, at the bullish order block. When it's down there and it opens and trades and goes into that candle, when you see that, that's when you want to be a buyer. And you expect price to expand up into an area where buy stops will be, because you want to find buyers for those individuals that want to take the position long or buy it for whatever reason, being a protective stop on a short. If you're long, like smart money would be buying down here, you're going to be looking to sell it for a profit. So you have to find willing buyers at a higher price, and they're always going to be above highs, old highs, above highs. That's where it's going to be at. Now, here's the cool part. This is the takeaway for today. If I show you what this really is, this is the Japanese yen weekly chart. And for this whole teaching this morning is to settle down those folks that have been talking about, I can't day trade. Can you give me a trade way to do this stuff where I don't have to be in front of the charts all the time? I can't be a day trader. I'm not sure I'm going to be able to stay with this mentorship because I can't day trade. This is a bullish order block. Fair value gap. Price trades down into it, closes it here. If you add 40 pips or so to it, okay, and you buy here and you get out at first profit here at this high, that's 1,154 pips, okay? These are weekly candles. 1,154 pips. How many times does it trade back down into the mean threshold here of this bullish candle, bullish order block? Hits it here. If you see that trade and you buy it at that point and you look for that move here, that's 960 pips. What about this candle here? This is a propulsion candle. Why is it a propulsion candle? We have a bullish order block, which is a down candle. We see price move through it. Another down candle right into that previous down candle. This candle here should not see its mean threshold given up. Okay. The opening of that candle, sensitive. You can buy it here. Old high back here. There's 753 pips right there. Okay. Another down candle here. Price hits it. Another expansion up. It trades down into what? This bullish candle. Rallies again. If you went and held a small portion, just buying it down here originally, and you held on a small piece of it, that's almost 25, well, yeah, it's 2,500 pips on one position. If you scale out and leave a little piece on, how many people have you come in contact with that made 2,500 pips in one trade? They're unicorns. They don't exist. The first chart I showed you in the example was the monthly chart of the Japanese yen. If you sold at the bearish order block as we defined it here, taking first profit down here, that's 870 pips. Down here, it's 1,610 pips. If you leave a portion on and you take a run out below this low here, that's 2,240 pips. If you wait for this low to form and then expansion below it again, that's 3,270 pips. Here's a short-term low here. If it violates that, it's 3,862 pips. Wait for this low here to form and then aim for a move below it. That's 4,200 pips. It takes a long time for these trades to pan out. So my question is, yes, there's plenty of opportunity to trade every single time frame. This bearish order block here, going short, just taking profit right here, that's 1,500 pips. Selling short of the mitigation block. Okay, here, with a move below these lows here, that's 1,330 pips. Now, you have to wait every single month for these candles to form. But you're telling me that you can't day trade, but you need to do long-term position trading. I just showed you on a monthly here and a weekly chart. There's thousands of pips available, and I use the worst pair in my own personal liking. I can't stand the Japanese yen. but it's still there. It's still there. If you look at the bearish order block here and you sell short and you look for a move below this low here, that's 1,000 pips. How many months does it take to get there? You trade short in this one, 1 month, 2 months, 3 months. 3 months, 1,000 pips, one position. So my question is, can you make 6% compounded a month over the course of these types of trades with a very small amount of risk? Of course you can. Absolutely. There's no reason for you to be worrying about whether or not I'm teaching in a intraday chart. It's the same premise. Everything I teach is universal, but you need to settle down and let me teach it to you, okay? Everything I've promised you in terms of what I'm going to deliver, you'll have it. And I want you to come away with this teaching today with the greater appreciation for price action, because it's not limited to intraday charts. So I'm going to give this session a close and remind you that we'll be back at 9:30 to do a panelist session. One of our members are going to actually get on here with me and discuss a meeting he had with someone I think is of interest. And if you had any eureka moments today from this one, share it with me on Twitter. And until we talk again later on today at 9 o'clock, good luck and good trading.